Good evening, all. Ira Epstein with your financial market wrap-up, and this wrap-up is for Thursday. And we're sitting here at the 19th of January, 2023, and the time's just after 5:30 p.m. Central Time. So I look at the market. I like what gold's doing. You know, the stock market fell pretty hard today, and some of the indices got a bit lower for the year, actually. So they gave up some real action that the market has had. Bitcoin's been going up every day. It had, I think, its first down day in quite a while. Bonds and notes going quiet at this point. You're still very strong in all of the all of the energies. And as you can see, I'm moving you over into the April now. And I think it's important that you move over into that April crude oil. The March will be going off the board soon in Brent. Why they do it so soon has always been a mystery to me, but they do. Natural gas continues under selling pressure. And what's interesting, be a bit cautious right there, because we're going to get another bout of cold now. The weather in the Midwest is going to change to much more seasonal weather, which means going to be in the 30s. We're still mid-January. We've been spoiled because it's been such a mild, for many of us in the Midwest, such a mild Christmas, and through this part right now. That's about to change on you. So be aware of that and understand the demand that comes with it. So as you and I take a look at the S&P, you know, the one thing that's good is the market is staying over the 18-week moving average, so it has upside bias. It is down nearly 2.5% for the week so far, and it could be targeting this 3,860, not 38,000, 3,860. Wouldn't surprise me if that's where the market wants to go. As I got back this week from vacation, I pointed out to you that you can take from the high to the low, and we had gotten about halfway on that retracement, and the market has been running into trouble ever since then. It's typical. I don't think we're in a bull market. You know that. I think we've had a bear market rally overall. And the question is, are you going to get a signal? So far, you don't. I must tell you. The pattern in the market is one of a higher high, lower low. I don't think that's a strong pattern. You are falling back into support at the 18-day average in the 100. Where did the market stop? In terms of moving averages, the 200-day with the combination of the Bollinger Band stopped the market like that. And that's what I teach in my enhanced Bollinger Band course. When we take a look over here, by the way, you can see how the market's just looking with the momentum turning down. Now, as we come over to the NASDAQ, the trend has still got higher lows, higher highs. But again, when you get a combination and the first time you come up to a Bollinger Band and a key moving average and you're not embedded, watch out. I was telling clients just 48 hours ago, saying, if this market's going to stay up instead of this break that we got, you'll develop an embedded reading in the slow stochastic. And that's where both numbers would be going sideways, in this case over 80. They haven't done that in this market for a while. It's been easier to get bearish. And you can see that you've had a number of the bear patterns and what the market does when that occurs. Both numbers lock in under the red, and if they were to lock in over the green, you'd get the bullish pattern. And I said, boy, that would be unusual because I'm not bullish at this point. I am not in the camp that thinks the Fed is going to quickly end anything. I am in the camp that the Fed is going to go with, I now believe, 25 basis point hikes, but a series of them. Probably 2 to 3, but 3's my number in my head. And then when they get to a certain number, they're going to stay there. Why? The labor market is too strong. Did you take a look at today's unemployment claims? Instead of going up as the market was looking for, you got a 15,000 drop. You cannot tell me that you're going to have a strong labor market in a serious recession. I'm not buying that. But there's another part to it. You can't tell me that you're going to get down to 2% inflation either with labor markets this strong. I, for one, am in the camp that it's fantasy to think we're going back to 2% inflation. I think the target is a dream. I don't think the Fed can do it without completely tipping over the economy, and that they won't do. So I believe it is a nice thing we think about, but it's for the school books. It's not reality. I think much more of a reality is going to be, and you'll hear talk like this, I think this year, that maybe somewhere between 3 and 4% is a number you got to think of. Just think about everything. The dollar, you can't buy a home the way our parents did. All right, my parents weren't rich. So, you come in, did they buy homes when I was a teenager and, a young boy before even a teen? Maybe they were paying $17,000, $18,000 for a home. What's that home now? So the rate of inflation as dollar gets more and everything around you gets more, to think it's only going to go up 2% and the numbers are bigger, I got my doubts. In other words, getting it down where it's just going to flatline there, I don't think that's reality. When is the last time we were there? That's another question we should be looking at. When you look at the Dow, you got up to the upper Bollinger Band, suckered in the traders to buy against it, and just pulled the plug on them. Now you're oversold. This isn't the spot that I want to get bearish. I don't think these markets are doing anything. I think it wore people out and got the guys going from Christmas right up until a week ago. I'm missing the boat. This market's going to go, and it doesn't matter. And now the market has come back. And as I said, in some markets, you actually got lower today for the year. You're not there in all the markets. Here's the strongest of the markets. And it's got to work its way down into these moving averages, and it's going to find support. You see how it came back and challenged the 200-day? Well, if it gets hit, it'll come to the other. But here's what also happened on a very positive note. The 18-day average got over the 100. Now, a true bull market, which you don't have on this chart in terms of moving averages, would have the 18 over the green, but the green over the gray. In other words, the 200-day. You'd have the 18, the 100, the 200. You don't have that. So there's a fly in the ointment, and it's a serious fly. Will the market even be able to stay over this 200? It hasn't had a good success rate recently. We'll see if it doesn't. But as a chart, it's in an uptrend. It's over the 18-day average. It's working off an overbought market. It couldn't embed and hold it, and that's the important part too. In the VIX cash, what did I say to you just the past 3 days as I've been here? I said that when the market got right here, I believe it was 1958, right where I'm pointing, I said I think the pros wrote puts. The idea to get to the 18-day average, that's been the play that I've seen year after year, every time you hit that bottom number, and that's what it tries to get to, boom. Now, what you don't want to see is a situation where it comes in and hangs and makes lower lows, but that doesn't necessarily blow out the pros. They put these on as longer-term trades looking for that scenario. They're not playing for the market to go from down here to up there. The play is from there back to the 18-day average and then see what the market does, and it's worked again. In the bond market, all we keep seeing is how low interest rates are. And that's got to be somewhat frustrating to the Fed as well. They want to slow the economy down. They want to slow down demand. They want to slow down job growth. And they're having a heck of a time in jobs. I was watching Lael Brainerd today, and she had a prepared speech, and I was hanging on every word as that was coming out and then digesting everything with it. Any way you want to look at it, and she's, I think, the dove. At least it sounds like that. Things will come down, but they're going to take a long time. And while the Fed has the 2% goal, I wasn't convinced that she believes it's attainable. In the 10-year note, you've got your embedded reading. Now, when the red line closes under 79, I will think you're going to make a run back to wherever that 18-day average is. Until then, what the market does is on pullbacks, you'll probably see support come in until that is lost. That's what I expect to start seeing over the next few days, that, the 5-year, and the other. But we're already at the 19th. You realize February 1st, we're going to see the first FOMC meeting of the year now, right? Be careful. Okay, the Fed, some people think they're going to go to 50 basis points. I don't see that yet. All the data that's come in just says to me 25, but who am I? I'm making a guess. In the dollar index, as long as you have a bearish embedded reading, bear camp. Lower highs, lower lows. Why not back to 101.24? Where it would change my mind? Well, get a settlement on the red line over 21. I'll change my opinion. In the euro, this is the flip-flop. I have the embedded bullish reading, which tells me these breaks are being bought with the trade looking for a move back up into the 109.5 area until the red line closes under 79. In the British pound, just strengthen the market, okay? It doesn't back off one way or the other. The bank, people are playing here in interest rate, that the bank's not going to be able to back off. They have so many labor demands. Here in France, are you watching in France with the arguments? Mr. Macron's getting his first real test on the pension argument. There's just strikes everywhere. There's strikes everywhere in the UK. People want more money. The bank has to keep raising rates. How do you get them to go back to work? They don't have the same laws there that we have, where you can't get the postal workers to go on strike. You can't let certain things happen to shut down the economy. They're working on it, but they're going to have to get it in different parts of Europe. In Bitcoin, we had just talked that you would approach your fifth day over the Bollinger Band and just move to the right-hand side. Now, moving to the right-hand side isn't bearish. When you force the market to embed, it just stays bullish until the red line closes under 79. And at that point, then I'll look for the market to make a run maybe for the 100-day average, the one in the green at this point. Now, I've put up the April Brent versus April WTI crude. It's time to make that move. They're not very much different than the March to March. The others around the 529 is 536 level. And it's just saying what the difference is. Remember, the lunar holiday begins this Sunday. And it goes, I think, until February 5th, if I'm right. So things are going to change a little bit in China as people travel. Companies, they have a real trouble getting people in. They got to work out their work schedules. And then you have the COVID situation. But this market's not paying attention to that. It's listening to the Chinese authorities and believing that China doesn't have the COVID outbreak that so many of us thought could devastate the country. Okay. When you come to the April Brent, you're overbought as can be. To me, this is not a spot that one would be loading up in this. In bed, maybe. I'll get friendly. Not here. This is where I think you're going to have trouble staying over the 100-day average shortly. Same thing as I see it in WTI. This does not mean I'm bearish. I think the market's too rich here in price is what I'm saying. Heating oil, look at how overbought you are. So I was surprised that the market so easily got over the 200 and the 100-day averages. Now, the seasonals kick in right now in a lot of the energies between here and March. The market puts on and starts a move, getting ready for the spring demand that comes from fuel for jets, fuel for gasoline demand. Right now you're still in the heating oil. You're going to do a switchover. When you do the switchover in American refineries, you don't get much demand for the crude, but you start eating into the stockpiles that you have on hand of other fuels. There's nothing bullish to say about nat gas. Just look at this market, how it's laying down. Same thing in Europe. It's just not there. And yes, as I said, we're getting back to more normal weather at this point. So definitely pay attention to that. That's going to be important. Now I'm going to hold the first webinar of the year. And it's going to be next week. It's going to be the 26th of January, 12:30 p.m. Central Time. If you're on my mailing list, if you've ever done anything, we probably have your mail. If you haven't blocked it, you were sent an invite. If not, you can just take your cursor, move to the very top here, and when you do so, you'll see an icon. From that icon, give it a click, fill out the form. You will then, at that point, have your invites. You'll get from us an email. When you get the email, my address is in it, my email address. If you want me to do spiders, ETF, stocks, whatever it is, just write me. It's right there. Let me create the charts. Give me time to do it because these webinars are, by my design, 20 minutes long. I do not post them that you can watch them. I certainly record all of them for regulatory purposes, but I want you there. Really not interested that, I couldn't make it. Can I see it? The answer is no, I'm not going to do that. You attend or you miss it. It's pretty simple. My time's valuable. I make the time, you make the time. It's that simple. If you have questions, you can call my staff, click the link. I'm Ira Epstein. I'll see you tomorrow.